Holy frickin' smokes, what the heck should we be doing? Should we be going cash heavy? Should we be sitting on the sidelines waiting for that market crash so we could go shopping when prices are lower? Well, today I'm going to react to Kevin O'Leary giving suggestions. Should you go cash? Should you go long on stocks? What about bonds? What is it that you should do? This interview with Kevin O'Leary was released on October 30th, which I figure, hey, you know what? That's recent enough to relate. So let's go ahead and play it and let's react to it. Also, one quick note, I kind of screwed up. When I posted my end of the sale video yesterday, that was my video where I did every noob investor does this versus pro investor, which I thought was a hilarious video, but apparently didn't do too well because I posted it on Halloween. In fact, that was my mistake, is I posted it on Halloween, which I want you to look at this. If you don't know how YouTube works, you see these little blue charts here? Yeah, the little blue bar charts or bar graphs, they tell you how many views you're getting in a 60-minute period. Well, let me put an arrow here and say this is how many views I got when I made a video about the Federal Reserve. And then this was the spike of views I got from my Halloween video. Which is a little frustrating since that means a lot of people didn't get the reminder that the sale was ending Halloween night. So I've gone ahead and extended it solely to November 3rd. That's it. And then if you know me, you know that I have a history of raising the price after these expirations. So you have another little quick opportunity to check it out. All right, let's get into the content, including you visiting me in San Francisco on November 16th. Okay, here we go.
I want to bring in Kevin O'Leary right now for reaction on the Fed. Okay, so we got that quarter-point rate cut. What was your reaction?
It was so highly anticipated, I didn't expect much other than we were going to get 25 basis points. But here's the issue. If you look at the whole data set today, there were two big surprises. One, how strong the consumer remains, up at that 3% growth, and also the 3% decline in CapEx spending with business. So these are offsetting, but
this is actually very, very good. What has surprised a lot of people in the marketplace is that the consumer still continues to remain as strong as it does, I guess, or as we do, since we are the consumers after all. Remember, 70% of our market is consumers. So even though Kevin O'Leary here said that, oh, well, 3% strength in consumer spending, but 3% decline in CapEx for businesses, which is kind of like a business buying machinery or computers or office equipment or expanding somehow. You know, he kind of mentioned there those might offset, but I actually kind of think they might not offset. In fact, I've been reading the Financial Times, and some of the articles that I've been reading have referred to this differential between, look, businesses could slow down their spending to make themselves more efficient or to prepare for slower times. But if those slower times don't come and consumers still stay strong or keep spending because they have more money or they have a greater perception of wealth, then business spending is not necessarily indicative of a slowdown in the overall economy or a market crash coming. Now, obviously, the global economy is slowing down, and there is slowing. But I just wanted to draw a distinction between consumer spending and business spending. They're not necessarily one for one.
I'm not sure now. I think the Fed may pause for a while. Things are not as bad as everybody had anticipated and not slowing as much as everybody thought.
This is huge. This right here is really, really big, that the Fed is probably going to pause interest rate, reductions, which is actually good, because the Fed would only pause reductions if things weren't really that bad. Like, if there were a crash on the horizon, or things were going to crash in the next 6 months, because the Fed knows it takes like 6 months for their policy to take effect, you would think that the Fed would drop interest rates to like 0 in panic mode if there was going to be a recession in the next 6 months. So I think everybody's pretty much on the same page that this whole recession 2020 thing probably ain't happening. It might be like, it's coming. It will come one day, but it's probably going to be a few years out. I personally, I said this about 6 months ago. 6 months ago, and my position hasn't changed much. I kind of still think, there's like 3-4 years of room. We'll see.
We look great on GDP, that we're going to kind of hang in at that 2.8, 2.93%. And so the Fed has to be looking at this saying, I think we'll take a rest. So and the market is at peace with that at this point.
Back near record highs.
Yep. I've looked. It's been what's been so resilient are two aspects. Number one, the consumer remains the strong pivot of job creation in America, unemployment under 4%, and continuing to spend on a healthy basis. And yet we're being thrown that bone on trade. We're being thrown that vision of maybe getting a deal over the next few years because...
Yeah, the same is true in Brexit. We're seeing kind of that bone in Brexit, while at the same time being thrown that bone on trade, like Kevin O'Leary here says, where it seems like, oh, we're getting solutions here. Consumers are still strong. Wait a minute. This crash or slowdown isn't as bad as it was kind of hyped up to be or would be. But so let's keep watching here to see what Kevin O'Leary suggests that we actually do, because I'm all about finding practical information, right? That's why we do news that makes you money, because it's all about practical stuff. Like if I can't watch a video and then do something afterwards, it ain't good to me.
We've got this stage one maybe coming on the 17th. I know it's a tertiary deal, it's mostly financials, it's not really IP and it's not really access to their markets, but it's better than nothing, and the market...
Just a clarification, IP is intellectual property, and access to their markets is obviously being able to have more US manufacturers in China. He's saying, hey, we don't have some of the bigger things we want, but at least it's something.
Is willing to wait for the rest of that.
And when you look at stocks compared to...
Oh, and intellectual property would be like patent protection, trademarks, brand names or deals, whatever.
To interest rates, I mean, we've got the 10-year yield now at 1.8. The last time the market was at a record high in late July, it was at 2%. So just that difference could be a bullish sign for stocks.
So I called around a few desks after all the data poured out in the morning and said, has anybody changed their mind about commitment to equities? Is there anything better to invest in right now for the next 12 months? Is there any strategy?
What Kevin is asking and what the other person is saying is, hey, the 10 years at 1.8. The 2-year, by the way, remember the whole inversion of the yield curve thing where the 2-year rate was like higher than the 10-year? That's bad? Yeah, there's no inversion right now. The 10 is like 1.8 and the 2 is, I think it's like 1.56 last I checked. The point, though, is the question. Kevin O'Leary is saying, he called around, and remember, Kevin O'Leary, in case you don't know, he's a hedge fund manager. So he places people's money and then tries to prevent them from losing money by hedging his bets. So Kevin O'Leary is getting on the phone and calling around going, hey, what's up, everybody? What are you guys doing in the marketplace right now? What dangers do you see? This is not a phone, by the way. This is an air conditioning remote control.
She would have you go to cash. What has changed on this data set that would make you not want to stay long going into the back end of the year?
Pick up what he just said there. What would make you go cash? That's big. What would make you go cash? That's a really, really big question. There's a lot of people are saying that. Oh, I'm gonna hoard cash, wait for the crash.
So I called around a few desks after all the data poured out in the morning and said, has anybody changed their mind about commitment to equities? Is there anything better to invest in right now for the next 12 months? Is there any strategy that would have you go to cash? What has changed on this data set that would make you not want to stay long going into the back end of the year? There is nothing changed. Would you still rather be...
There it is. Nothing has changed. So Kevin O'Leary says, hey folks, look, we just got this new data from the Fed. The Fed release came out. What would make you go to cash? What would make you not go long on equities through the end of the year? Just so you know, that means what would make you not stick in the stock market through the end of the year? So as in, like, is there any reason you're selling your stocks right now going to cash? And based on Kevin O'Leary's calls, the answer is no. Don't go cash. Stay in stocks. In fact, then Kevin clarifies and says, you should basically, in so many words, get into stocks, because if you don't get into stocks, you're missing out on juicy gains in stocks that we're seeing and Kevin is expecting to see, and you're missing out on dividend yield, which let's see if Kevin gives us any guidance now on what exactly we should be investing in. And obviously, you get my commentary as well, because that's why you're watching this video, is you meet Kevin.
Be in equities, you still rather get those dividends. They're far better than going long duration on corporates or on govies.
Okay, also a clarification there, because Kevin speaks in this very financial jargon here. He basically just said stocks are way better right now than investing in corporate bonds or government bonds, because those yields are very low. You're not making a lot of money on bonds right now, which are historically a more protectionist asset. That is, if you think the market's going to crash, you put your money in bonds, and that way you take a little bit of money while other things don't do as well. That's what Kevin's saying here. But let's keep going.
So I think we're in the pause that refreshes, but near the highs. What's wrong with that?
Ooh, that's an interesting challenge there. We're in the pause that refreshes, but we're near the highs. What's wrong with that, though? He's actually making a very interesting point. You know, he's basically saying, so what? We're at all-time highs. Like, does that mean the market is now fundamentally flawed? Maybe people are making more money. Maybe businesses are earning more money. Sure, debt levels might be up, but if people have more wealth and more money, is that necessarily bad? Interesting. Like, no matter what side of the spectrum you're on, whether you think this is like all fugazi, cheap money, fake, everything, market's gonna crash, hyperinflation's coming, or you think, oh, I don't know, crash is coming or crash is not coming, it doesn't matter. This is an interesting POV, and it's one you should be using to challenge your own.
So how would you be positioning your investments? Because I remember the end of last year, we were talking about how high-quality dividend stocks were in vogue. Maybe tech had fallen out of favor, but maybe that's reversed now almost a year later.
It's interesting. Both have worked, because if you were willing to take the volatility provided by the high PE techs, you're back where you started. You've just had a bit of a ride. But I have stayed, my core asset holdings remain my own index, OUSA, because I own, about 138 of the S&P 500 that have the highest quality balance sheets. That's a safe place for me to live. I don't tell people how to invest. It's what I do.
So just so you know what the heck he's talking about, here's OUSA. It's an exchange-traded fund, which is basically like an index fund, because an index fund is an ETF, an exchange-traded fund, except rather than being the entire index, like the S&P 500, Kevin O'Leary basically says, hey, I went in, I picked 138 of my favorite stocks out of the S&P 500, and I created OUSA, which he calls the O Shares US Quality Dividend ETF, which this year it looks like it's gone from a price of about $29.90 to about $35. So what do we got here? $29.90 to $35. It's about a 17% annual gain so far. So not annualized, just so far this year, which is great. Let's see the dividend. The dividend on this, by the way, it looks like it pays a 2.48% dividend, which is actually very, very good. So he probably went through and picked his favorite dividend-paying stocks in the S&P 500 and made an exchange-traded fund out of that. It's kind of cool. That's where it sounds like he's putting the majority of his money. So he's actually aligning with sort of the S&P 500, except it's the Kevin O'Leary refined S&P 500 fund. Which, honestly just reiterates that if you have a model that works, you should replicate it. It's kind of like me. If I have a model of buying real estate below market value single-family houses, I'm gonna buy more and more and more of those. Like, why change it? If I could buy a house, make $100 grand and move on, I could show you how to buy a house and make $100 grand in my real estate investing course link below. Why would I not keep doing that? Like, I would be a madman not to keep doing that because it wouldn't be congruent with how I'm investing. All right, let's continue on here with Kevin.
That's a safe place for me to live. I don't tell people how to invest. It's what I do, because I want that 2.8, 2.9% div yield I get. But
he says 2.829 here. Based on some websites, it looks like it's at 2.48, but we'll just, whatever.
I also use OGIG, which is, a huge basket of global internet players that include all the FANG stocks, and they're back up near their highs again. People want growth, but they don't want just domestic FANGs. They want international growth.
So here's that other one he's talking about, OGIG, Global Internet Giants. So I guess that's how he gets exposure to China as well. Oh, that's interesting. Look at this. Alibaba, Facebook, Alphabet, Amazon, Microsoft, Netflix, and then some other ones like Wayfair's in here and that. Oh, that's interesting. So it gets you that exposure to the internationals as well. Ah, cool. So after this part in the video, Kevin O'Leary goes down the rabbit hole of talking about, basically, without mentioning her name, Senator Elizabeth Warren's interest in breaking up Facebook and Amazon, and he discusses his reasons for why he thinks that's a bad idea and why they shouldn't be broken up. which, if you're not familiar with that, Senator Elizabeth Warren is basically very interested in taking these larger companies like Facebook, Microsoft, Amazon, dividing them into different kind of competitive units because they're too big. They're almost like their own little monopolies. They should be broken up so they can compete against each other, and they should be taxed significantly more than they currently are to provide social services like currently in the news, Medicare for All, a campaign slogan of Elizabeth Warren's. Now, hopefully I didn't butcher that. I'm hoping to stay apolitical here and just give you what basically the rest is that Kevin here commented on. You can check out the link below to Kevin's video. Let me know what you think. What are you doing in the marketplace right now? Are you looking to buy stocks? I know I'm looking to buy stocks on red days, so I'm waiting for my next red day and I'm going to go shopping again. I'm also hunting for more real estate deals because there's nothing like buying below market value real estate. And folks, if I don't see you in San Francisco on November 16th, make sure to join me in Vegas on 2020. Yeah, that's an actual date. I got the better date over Grant.